Well, good afternoon. It's Michael from beautiful sunny Scottsdale, Arizona. It's 79 degrees, and last night it was down into the low 60s. So sleeping was just wonderful. I feel great today. So please come and enjoy Christmas here in Scottsdale, Arizona. When you get in come January and February, we just have so many things going on. It's just incredible. Hey, a couple things. The Trump tax. I mean, you've got to be excited about that. That is just absolutely wonderful news. If it gets implemented as it stands, it looks like it will probably drive the economy just wonderfully. I think it'll put people back to work, and we really could have a driving economy. First, however, I think we need to go down and just kind of clear all the trash out, as they say. I think that the stock market is, personally, remember, I'm a real estate guy, not necessarily a stock guy. I do like to watch the cycles, and this one seems like it's unfolding like all the others. They spike. You've had central bank intervention. Whenever that doggone central bank gets involved, why they make things too extreme, and you've got a pretty big spike. Martin Armstrong thinks it could double. Well, gosh, that would be absolutely incredible. We'll see. We'll see. Already, that some of the private wealth is selling. Institutional money is selling, and there's a lot of hype to get the stock market as high as they can because they're selling their portfolios to the retail people. So when you get this euphoria towards the end, why everybody wants to get in, they're generally getting in at the last time, and it's the private money. It's the people who bought when things were really, really bad. They're selling their portfolios, and the higher it goes, the more money they make when they sell to you. So just keep that in mind. And the same thing with bonds. If you take a look at the bond spike. Why the bond cycle is about 70 years long. It's 35 up, 35 down. And I think you can all agree that 1980-81 was the end of the bond cycle. It was the down. So that was the end. It was a pretty spectacular ending when Volcker got involved. There again, Volcker with the central bank, and he raised short-term money up into the low 20s, and of course made a huge spike, just destroyed bonds. And now we've gone to the other extreme, in that here again, the central banks of the world have bought all the bonds, suppressed interest rates down to zero here in the United States for I don't know how, almost 10 years, and are even negative in Europe. So bonds have just gone exact opposite. They've spiked like nobody's business. I mean, Martin Armstrong has us down at 5,000-year low in interest rates, and of course that makes bonds really, really high. Now, when they're this high, it's a spike. I think in bonds, if you look at that, you're probably guaranteed to lose money, because I think rates will go up. Even if they just go up a little bit, you're going to lose money. So you really need to take a look at your stock and bond portfolio. I would take the original investment off the markets. You don't have to be invested 100% of the time. You know that. So just keep that in mind. That prudence tells you that you want to preserve your wealth for the future. So if we do have what I think is probably going to be some turmoil in the economy, that you have some capital with which to take advantage of any down moves, because the next cycle is probably not going to be in the financial. Remember, keep in mind, financial is just a claim on real assets. It's not real assets. Real assets are the real things. When you have a claim like stocks and bonds, it's a claim on income, and of course, what happens if that claim goes away? Oftentimes, bonds can default, and companies can bankrupt, and of course, that claim goes away. Real things do not. So we have a real thing. We've had a financial cycle where the financial products have far outweighed real assets, and now we're starting to get that cycle is going to turn. We all know that life is a series of cycles, and we're going to be coming into the real asset cycles. You can see the commodities are starting to bottom, and those, of course, are real things. That's what they make refrigerators out of. That's what they make roofing tiles out of. That's what they make roofing paper and lumber and concrete and copper and iron ore. All those things are bottoming. And you know what they make out of all that stuff? They make single-family homes. So I think that the single-family home here again probably becomes a very, very good investment. So not only is it cash flowing through any kind of turmoil that we can possibly have, we can have a Mad Max event, and of course everything's all the chips are off the table at that point. But if they don't, we have an asset that just keeps cash flow because it has a use factor. We've talked about this. It has a use factor. People need a place to live, so we provide a place to live, and they pay us a rent for that. If things get really, really bad, well, we have to reduce the rents, but we still get rent. So, and then if the cycle comes up, which we expect it to do, so if the commodity cycle comes up, then what we expect is that you're going to see gold, you're going to see silver, you're going to see natural resources, you're going to see iron ore, you're going to see lumber and trees. Copper is all going to get much more expensive. And this is the building blocks of single-family homes. This is the construction of single-family homes. So single-family homes, the materials will drive the prices higher. And of course, if you have single-family homes and the price of single-family homes are going up, being driven by a commodity cycle, why, that's wonderful. So I am anticipating that we get both a commodity cycle push, which I think is going to become pretty soon, and we're in the middle of a real estate cycle. Our real estate cycles are 18 and a half years long, so I don't expect to have a peak of 18 years from 2005. It takes us up to 2023 and a half, so we should be looking 2023, 2024 before we peak, and it could be if we get central bank intervention, it could be quite a peak. So that's what we're accumulating for, is that we're looking for that peak in 2023, 2024, where we're going to get a push from the commodities, and we're going to get a push from the central banks. So I think that's a safer play. I think that the stocks and bonds are financials. I think that financial cycle is probably pretty well played out. And it's going to end. And when it ends, of course, it goes down. And it can go down in a pretty spectacular fashion. If you look at the peaks, we've talked about the peaks. Peaks are really fun. Going up the peak is just a blast. Everybody's excited about that. Everybody's making money. And, you're on a cocktail circuit, you're out having dinner and lunch and stuff and just telling everybody what a genius you are because you're on the train. It's just that sometimes the trains fall off the tracks. And when it does, it's just not very much fun at all. So listen, here's what I'm going to suggest to you is that you take some of your money off the table. We've talked about this before, just to be prudent, just so that you're keeping your wealth for future use. And of course, you've earned a lot of money in the stock and bond market. I would take and preserve that money. You don't necessarily have to jump right into real estate right now. If you're going to be doing any kind of financing on your investments, and here again, we're very, very conservative. We like leverage, but we like very, very conservative leverage. 30% down, 35% down, something that makes really, really, we're just very conservative on this. Interest rates are probably still pretty good. I mean, they're still pretty compelling to put a 30-year mortgage on, because I think in the outlying years, in 2 or 3 years, particularly if things get going, we start having demand for money, real demand, not stuff that's from the government. We're talking about real demand on money. You're going to see interest rates go. And also we may have some credit issues where lenders are thinking, well, maybe we don't get our money back. So interest rates across the world will probably rise, and that's why I'm so concerned about bonds. So, and if they do, of course, it's going to make mortgages much more expensive. So if you're going to get a mortgage, now might not be a bad time to do that, and consider that. So listen, this is Michael wishing you the very, very best from Scottsdale, Arizona. If there's anything that we can do for you, please give me a call. We have a full staff here. We do an awful lot of pension work and retirement work. Really, I work with people my age a lot, and we try and make income to make your life so much better. So this is Michael saying goodbye to you, and give me a call if you need me. My very best to you now. Bye-bye.